Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's dive right into one of the most structurally perplexing market situations we've seen in a while. SOBR Safe Inc. This is as of early 2026. The stock's trading around, what, $1.76? A number that seems completely mundane until you look under the hood and realize the cost to borrow, the CTB, is just skyrocketing. We're talking over 900% annualized.
Which is just, it's almost unbelievable.
It is. I mean, think about it. Short sellers are paying over 2.5% of their position's value every single day just to stay in the game. That isn't just expensive. That's financial combustion.
Well, I'd argue I come at it from a different way. That extreme, unsustainable cost is the price the market is demanding to bet against a company whose underlying financials are not just weak, but you could argue terminal. So this isn't some random paradox. It's a direct conflict between technical scarcity and fundamental distress. So the central question for us has to be, is SOBR safe primarily a high-volatility, short-term technical play driven by this immense crushing short position, or is the dominant overriding factor the fundamental financial necessity for highly dilutive and, let's be honest, toxic financing?
And I'll argue pretty vehemently that in the immediate term, the technical indicators define the entire market action. The high CTB makes the short squeeze potential the overriding immediate market factor. Look, if you just look at the data, approximately 573,500 shares are held short. Now, given the current flow, that's almost 41% of the readily available trading pool. That is an exceptionally crowded short position. That astronomical 938% CTB isn't some static expense, it's an active mechanism of pressure. Short sellers are being forced to cover even when the price is just moving sideways, simply to stop the daily bleed. It's a classic high-stakes short trap.
A trap, maybe, but it's a trap they're willing to walk into because they are fundamentally correct. The underlying premise of their trade is that the company must collapse due to financial gravity. They are willing to endure that daily pain because the long-term payout is, well, practically guaranteed by the company's structural flaws. The stock's performance is entirely dictated by its desperate need for cash. This company operates at a staggering annualized burn rate of about $8 million. And to put that in context, their entire Q3 2025 revenue was just a bit over $108,000, while operating expenses for the same quarter were greater than $2.26 million. I mean, they're funding 94 cents of every dollar spent using external, dilutive capital. This is not a sustainable business. It is a cash furnace.
See, you're focusing exclusively on the furnace without acknowledging the fuel they're trying to generate for the future. The stock's valuation, elevated as it is, reflects the option value that's embedded in their proprietary technology, the SOBR check and SOBR Shore systems. This is passive, non-invasive transdermal alcohol detection. It's meant to disrupt the messy legacy breath and blood testing market. And the company is actively transitioning to a high-margin software-as-a-service model. We saw strong sequential growth in Q3 2025, 136% year-over-year revenue growth, and a strong 55% quarter-over-quarter increase in Gen 2 shipments. Now, while the absolute numbers are small, that momentum provides the narrative strength needed to maintain retail confidence and, well, to fuel this exact technical speculation.
I'm just not convinced by that line of reasoning because the financing structure completely undercuts any value from that growth. You can't build a SaaS company on toxic debt. I mean, the dilution trap was set with the December 2025 private placement. These sophisticated investors received 100% warrant coverage, exercisable immediately at a low strike price of $1.30 per share. This is the definition of cheap paper. They didn't buy in because of $152,000 in annual recurring revenue. They bought a guaranteed arbitrage play. And here's the ticking clock. The January 13, 2026 S1 registration statement registers these shares, millions of them, for resale. Once that S1 is effective, the floodgates open. The massive, immediate increase in tradable supply will fundamentally shift the supply and demand equation. It provides the exact liquidity short sellers need to cover cheaply, extinguishing the squeeze potential, maybe instantly.
I agree the S1 is the inevitable ceiling, I do. But until that ceiling hits, the market is operating under conditions of extreme scarcity. The availability of shares to borrow, it often fluctuates between 0 and maybe 35,000 shares total. That is practically no float. This means that any positive news, any surge in retail interest, even a small order book imbalance, it just results in a violent, disproportionate upward move. That scarcity, fueled by the short interest, is the dominant factor today.
But what rational person pays 9 times revenue for a company that is burning $8 million a year? Let's drill into the valuation, because this is where the technical play really breaks down under any scrutiny. SOBR trades at 9.3 times trailing 12-month revenue. I mean, that is an absurd multiple for a company facing going concern risk.
That's an interesting point, though. I might frame it differently. Why do you use the comparables that you do?
I use market comparables. We look at competitors in the monitoring space. You have Track Group, which is also in the monitoring and detection space. It trades at 1.2 times revenue. Verify Me trades at a mere 0.4 times revenue. That 9x premium implies an aggressive, exponential growth trajectory that the delivery numbers simply do not support. We're talking about only 277 Gen 2 devices shipped in Q3 2025. You are asking the market to accept a high-growth SaaS valuation based on the output of what is essentially a small manufacturing operation.
Okay, I acknowledge the multiples is highly elevated, but this is a classic narrative trade. The market is pricing in the disruption risks to the old guard, not the current sales volume. We have to consider the total addressable market for non-invasive testing in, fleet management, logistics, occupational safety. That market is enormous, and their technology is unique. It's like buying Amazon when they were only selling books. You're buying the disruptive potential.
That analogy fails because Amazon had a sustainable business model from day one. SOBR doesn't. And regarding your point on comparables, you mentioned Track Group. Yes, they trade at 1.2x revenue, but they are absolutely drowning in debt, over $42 million. SOBR's balance sheet, by contrast, is relatively clean with low debt. They chose an equity-heavy funding model precisely to maintain financial flexibility, which is crucial for a development stage company, and that is an asset that the market is willing to pay a premium for over debt-laden peers.
They are not paying a premium for low debt. They are paying a premium for the promise of a technology that may or may not reach critical mass before the cash runs out. And the way they are spending the cash they do raise, it just speaks volumes about where management's priorities lie.
And you've hit on the next critical point, governance misalignment. We have to talk about where this capital is going, because it is not all going toward R&D or expansion. The financial filings, they disclose some severe governance red flags. In fiscal year 2024, the CEO, a Mr. Gandini, had a base salary of $300,000. Additionally, his 2 sons received combined compensation of $255,000.
I see where this is going. And yes, the optics are terrible.
The Gandini family collectively drew over $500,000 in cash compensation in a year where the company's total revenue was only around $200,000 and the net loss exceeded $8 million. It's mathematically absurd. It signals that management is incentivized to maintain solvency and a public listing simply to ensure their high salaries are paid, rather than focusing on achieving actual profitability for the public shareholders who are funding this lifestyle. This governance model is a massive, fundamental deterrent to any serious long-term institutional investment.
I'll concede that the revenue to compensation ratio is highly problematic and it warrants scrutiny. However, we have to recognize the unique pressures on microcap technology companies that are aiming for rapid scale while maintaining regulatory compliance. They have to maintain a NASDAQ listing, and that requires complex infrastructure. High G&A is not just salaries. It includes specialized legal counsel for securities law, expensive audit fees, and general compliance costs that a small private company just wouldn't bear.
But the $500,000 is going directly to the family, not just to outside counsel.
It is, and that is the optics problem. But in these early stages, management compensation is sometimes a necessary cost of maintaining the funding mechanism itself. The CEO's active communication, the promotion, if you will, of the company and its vision is essential to maintain the necessary retail confidence. That confidence is what keeps the stock price elevated enough to facilitate the very equity raises that keep the doors open. If the stock drops dramatically, they can't raise money, the company fails, and the option value of the technology just vanishes. It's a cynical trade-off, I'll grant you, but it's often the reality of survival in this capital market segment.
So you're making a pretty remarkable claim that the high salaries are justified because the executives are effectively paid promoters whose primary job is to keep the stock price buoyant enough so they can dilute public shareholders to keep drawing their salaries. That's not a business model. That's a perpetual dilution machine designed for management enrichment, not shareholder returns. The moment institutional investors see this, they run. And the explicit going concern warning in their financial filings confirms the severe uncertainty about their ability to sustain operations.
And that brings us right back to the short-term technical play. The smart money may be running from the fundamentals, but the quick money is running toward the volatility created by this short trap. Let's refocus on the arbitrage mechanism that the shorts are facing. I'll reiterate, the cost of carrying that short, that 900% plus CTB, is financially punitive. It means they must see a guaranteed, massive, and immediate drop to justify the daily burn. They are bleeding cash every single day waiting for that dilution event.
And they are enduring that pain because they know the S1 filing guarantees the outcome. The professional short seller rationale, held by entities like Intracoastal Capital, is entirely sound. They're betting on the mathematical certainty of supply and demand. They know that when the S1 becomes effective, millions of new shares, likely millions of shares in the first tranche, will hit the market, created by the warrant holders who are already in the money.
But that's a bet on timing.
It's a bet on inevitability. The warrant holders have an immediate, risk-free profit incentive. If the short squeeze sends the price to $3, the warrant holder exercises their warrant at $1.30 and sells immediately at $3, locking in a massive profit. They are incentivized to sell into any short-term spike, actively suppressing the price and providing the liquidity the short sellers desperately need. The S1 effectively flips the market structure from low float, high cost to high float, high supply overnight.
But until that flip occurs, the technical pressure is immense. And look at the last price action. We saw that spike from $1.60 to $1.90 on relatively modest volume just a few days ago. That movement demonstrates how quickly a small amount of buying, maybe driven by a positive contract PR, can force covering. If the short sellers can't easily access the shares they need to exit their positions, they risk a margin call, sending the stock spiraling upwards uncontrollably. And this risk is exponentially magnified by that 900% CTB.
The shorts are willing to tolerate that volatility because they know when the S1 becomes effective, they have a definitive, guaranteed exit that will validate their trade. Paying 900% for 30 days is acceptable if the stock drops 60% immediately after. The smart money is focused on that guaranteed exit. They are exploiting the fact that the company must dilute to survive. The warrants are essentially a contract to profit from the eventual price suppression.
You are assuming the effectiveness of the S1 is a fixed, immediate date, but the regulatory process can always experience delays or amendments. Every single day of delay puts more pressure on the shorts. This delay, however minimal, preserves the market dynamic where structural scarcity and exorbitant cost define the trade. This makes SOBR Safe a unique volatility product that is highly attractive to speculative players.
I understand the attraction for speculators, but the financial laws of physics remain constant. The company is fundamentally unable to fund itself through operations. The dilution structure is predatory and designed to extract cash from the public market to cover operational losses. The option value of the technology you cite is only realizable if the company can survive the dilution. But the dilution is so intense and the resulting suppression of the share price so guaranteed by the warrant arbitrage that the long-term prospects are severely curtailed if not eliminated entirely. The technical pressure is a temporary fever dream. The fundamental insolvency is the disease.
The trade right now is defined by structural scarcity. creating a violent opportunity.
And the entire investment thesis beyond the next few weeks is defined by structural insolvency, creating guaranteed long-term decay.
So to summarize my perspective, the immediate market situation for SOBR Safe is, well, it's entirely dominated by the structural scarcity and the exorbitant cost required to maintain that massive short position. Yes, the company faces severe, life-threatening fundamental issues. The $8 million annual burn is unsustainable, and the S-1 filing certainly imposes a definitive ceiling on any sustained appreciation. But until that regulatory hurdle is cleared and those shares are tradable, the technical pressure on the short sellers defines the immediate trade. For speculative players, exploiting that 900% CTB by betting on a temporary squeeze remains the most salient and powerful market force in the very near term.
And my position holds that the company's financial foundation is fundamentally weak and it deteriorates daily, relying on constant, deeply predatory financing simply to cover multi-million-dollar operating losses and inflated executive salaries. The explicit going concern risk isn't just a filing formality. It reflects the grim reality that institutional capital will not support this structure. The S-1 filing isn't merely a ceiling, it is the inevitable monetization of the dilution trap. So time is decisively on the side of the bears, and any short-term squeeze created by technical pressure will serve only to provide better exit liquidity for the sophisticated warrant holders who engineered this dilution in the first place.
Ultimately, analyzing SOBR Safe requires any sophisticated investor to weigh two highly volatile and opposing certainties: the certainty of extreme near-term technical pressure versus the certainty of long-term financial dilution.
And the material makes it clear that the ultimate outcome depends entirely on which force wins the race to the S-1 effectiveness date, a date that will mark the transition from an ephemeral technical war to an undeniable fundamental rout.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.